Hey folks, welcome to a product review at Finominal. Today we're going to look at multi-strategy hedge fund ETFs. And there's only three of them. So today we're going to look at a product from First Trust, one from Unlimited, and one from New York Life. And two of those have only been launched recently, which is the one from First Trust and the one from Unlimited. And that's based on the recent success of a few select multi-strategy hedge funds like Millennium or Citadel, which effectively have, as per the name, multiple strategies that aim to offer uncorrelated returns to equities and fixed income markets, and therefore provide investors, like with attractive, diversifying characteristics. Now, the hedge funds have actually achieved that in a sense that you can see that from the AUM growth, which has been massive, if you look at a Millennium or similar firms like that. So let's investigate if those ETFs that aim to replicate multi-strategy hedge funds are also offering similar attractive characteristics. Now, we're going to kick off with simply seeing how similar or how different these three ETFs are. And we're first going to focus on the correlations to the stock market and bond market. And so over here, you can see the correlation of those three products to the stock market and fixed income market. Now, what we do see that two products, which are the products from Unlimited with the ticker HFND and the one from New York Life with the ticker QAI, actually have fairly high correlation to stocks, around 0.7, 0.8. The one from First Trust with the ticker LALT, for liquid alternatives, is less correlated, but it's still fairly high at 0.5 effectively. Now that's already highlighting the first perhaps primary issue in a sense that these products are supposed to provide uncorrelated returns to make them attractive diversifying strategies, but are not. We can verify that a little bit further by running a short factor exposure analysis. We do see that the correlation to the S&P 500, not a correlation actually, betas to the S&P 500 were relatively high with 0.5, 0.3 for the product from Unlimited and New York Life, and that's naturally not great, right? We can also look at the risk sources, and to be frank, we only have 2.1 years of data, which is not that much, but we do see that about 70% of the returns of HFND and QAI can be attributed to the stock market. So if the stock market goes up, these products will go up. If the stock market goes down, these products will go down. In contrast, the product from First Trust, right, this seems to be more diversified. We do see there's some exposure to stock market, but also fixed income, to the Jones, and actually most of the returns are unexplained. And that's looking more attractive in the sense that that's exactly what you want, right? When you invest into a multi-strategy hedge fund or an ETF that aims to replicate those, right? That you get returns that like you cannot explain, that represent alpha at the end of the day. So that's in terms of some of the portfolio characteristics, right? We can also look at the performance of these three products, right? As mentioned, we only have 2 years of data because LALT was only launched in 2022. Now, we are going to use a benchmark to kind of like compare those products. And what I've created is a simple portfolio comprised of the S&P 500 that gets a 20% allocation and US Treasury bills that get an 80% allocation. Now, the reason for using this benchmark, this kind of like diluted equity benchmark, is simply because these products have high equity exposure, right? So if your beta correlation is higher to the stock market, then it seems you are providing diluted equity exposure. Now, what we do see is that all three products, two of those products actually made money over the last 2 years. The product from HFND did not. However, more concerning is, right, that you can see the simple portfolio of equities and cash, right, outperformed all of them despite having the same returns or similar trends in returns. And of course, that's mirrored by the correlation to stocks. Now we can also look at this from a risk and return perspective, right? We can see that over here, in terms of featuring the highest level of volatility, is a product from a limited with more than 8%. The other two products are a little bit less volatile. Having said that, from a Sharpe perspective, none of them are particularly attractive compared to the simple equities plus cash combination, right? So if you do look at the Sharpe ratios, right? So the Sharpe ratio, lowest one is for HFND with 0.48, right? The highest, or actually the ones from First Trust and the product of New York Life, they're fairly comparable, 1.25, but that's far lower than what this portfolio comprised of T-bills and the S&P 500 have achieved, which is 2.8 from a Sharpe ratio perspective. As mentioned, it's only 2 years of data, right? So we have to discount that somewhat. You can actually cross-challenge, right, that now we are comparing hedge funds to kind of like an equity benchmark, right, even if it's diluted equity. But to be fair, those products have high equity exposure, right? And we can actually highlight that, right, by showcasing, again, if I take this portfolio comprised of the S&P 500 and cash, the product from HFND has a 0.7 correlation to that, right? And again, QAI is 0.76, right? So this seems to be an appropriate benchmark. Now, if we want to give those hedge fund ETFs a fair chance, right? And perhaps, like just looking at that from the last 2 years, right, where we have data for all three that penalize them somewhat, we can take that product from QAI, right, which has a track record of more than 10 years, right? And we can also look at that to give them a little bit the benefit of doubt. Having said that, if we do look at the performance of QAI, right, since 2009, actually, right, we can see similar trends in performance, right, to the simple cash and equities portfolio, but a much lower return. And the correlation remains high at 0.7, right? So even if we extend the track record, right, of QAI, it doesn't make it more attractive. And that kind of concludes our analysis of these three products, right, where effectively the aim is to provide kind of like uncorrelated returns, right, that make these attractive for traditional equity and bond portfolios. Having said that, the correlations of all three are too high. They should be close to zero, right? Now, you can argue that these products are simply replicating what multi-strategy hedge funds are doing, and therefore it's not their fault, right? Because if multi-strategy hedge funds have high equity exposure, these things just replicate them. But then our argument would be, well, then don't invest in multi-strategy hedge funds because you can simply reduce your equity exposure and you get the same product for a fraction of the cost. Hope that helps. Have a nice day.